In today's video, we are going to look at a case study that examines an individual who has a lump sum of $100,000. He'd like to get that $100,000 into a policy, maximizing the cash value. And then after the lump sum, he stated that he would like to fund the policy with $30,000 per year through policy year 10. After 10 years, he doesn't really want to fund the policy. It will be designed in a manner where he can continue to pay into it if he wants. However, because he wants to stop funding after 10 years, guess what? We'll stop funding after 10 years. So here's what we've got with respect to the case details. We've got a 32-year-old individual. He wants a policy and he stated this right here: I want it maximized for cash value. That is my goal. What I have is a lump sum of $100,000. After I fund that, that'll be in the first policy year. I want to fund $30,000 per year, years 2 through 10. So in a case like this, especially when someone's new to whole life insurance and they're attracted to the cash value benefit and such, I do like to show more than just one option, at least one alternative that I would like to see if I'm in his position. So with the two options, they are going to have very, very similar performance. It's really just a question of which one are you more comfortable with? Because what I have found from experience, when someone is brand new to cash value life insurance, maybe not brand new, but they're still in the research phase, starting with a lump sum of $100,000, granted it is excess funds in cash. If someone's really worked hard to build that up and they've got $100,000 in their bank account, and now they're going to send that all into a life insurance policy, and the bank account balance is zero, or maybe it's not zero, they still have their emergency funds in there. But my point is the 100K is gone. As much sense as it might make from a numbers standpoint, that can be very, very difficult emotionally. So for that reason, what we can do is look at potentially splitting the lump sum up. So starting a policy with a lump sum, cash leaving the bank, that can be challenging for some. Usually after one gets comfortable with the policy and they personally experience how easy it is to access the cash value and such, then we see, okay, I'd like to add more to it. But in the initial stages, if you're not comfortable doing that, that's okay. What we want to make sure of is that we find a design that is comparable, meaning it doesn't sacrifice performance. That's the big thing. So what we're going to look at here is funding the policy with a lump sum, and then also splitting that lump sum up over 2 years. Now, what I'll add about this is there is a difference with the minimum premium in these two examples. So if flexibility after the first year is a concern, the minimum premium will have an impact potentially on what policy he goes with. So let's take a look here. We will begin with the lump sum funding option. So we're going to look under the hood, meaning we're going to look at the detailed illustration as well so you can see exactly how this policy was designed, because questions will come up in a case like this. Annual funding, $100,000 in the first year. Look to the left. What's his minimum here? $3,500. How is it so low? You'll see in a little bit. But a benefit to a design like this, look at that first year cash value. 94% right out of the gates. High death benefit, because at his age, $2.5 million is needed to give him a MEC limit of $100,000. So this is a non-MEC policy. $94,000 is what he has access to. The maximum loan will be based on that $94,000 amount. So this is very cash rich upfront with a large lump sum like that. Then $30K per year thereafter, break even point, year 3, meaning he's paid $160 and he has $160. That is an early break even point. This happens when I have a very large lump sum going into a policy in the first year. We'll also see it with a 1035 exchange because we're duplicating in many ways what's going on here. There's the funding though through year 10, and he gets a total of $370,000 into the policy over that 10-year period. So his minimum commitment each year, this is a combination of the base premium plus all term riders, is $3,500. Everything else is PUAs. That's his minimum commitment, $3,500 per year. And he's starting with a lump sum of $100,000. That's attractive, isn't it? It definitely is. Now, at the same time, while that minimum commitment is attractive, the 100K right out of the gates might be a challenge for him. It is not for everyone. It really depends where you're at in your research and how much you're comfortable starting with right out of the gates. But if he says, that 100K immediately, I get it, I'm just not comfortable with it, what he can do is this. So here's the same product, which again, we're going to look at the design in a minute here. But what do you notice different? The annual funding, $65,000 years 1 and 2. So by year 2, his total funding is what? $130,000, which is identical to the first option. So now his out-of-pocket is the same. Now, the second year cash value, $124,000, compared to $127,000, they're very, very close here. What's the difference? That column on the far right will give us the difference. This will display how much more or less he has in cash value with option B compared to option A. And what you'll notice, there's not much difference at all. There's a slight difference in favor of the 2-pay option, meaning spreading that lump sum up over 2 years. And again, it's minimal relative to the dollar amount with this product. But then if we look at the same product with a different PUA fee, it's the opposite, where the 1-pay is slightly more favorable. My point is, there's not much difference when we look at the options here. In my opinion, there's 2 main factors to consider. How comfortable is he starting out with a 100K lump sum? If that's going to make him lose sleep at night or he's going to stress out over it, he just doesn't want to do that, then I wouldn't do it. That's point number 1. And then point number 2 is the minimum premium. What's the minimum premium with these 2? Over here, $3,500. Over here, it's about double, $6,300. So here it's a bit higher. If he's not comfortable with that, this one might be a little bit more appealing to him. However, he did say 30K per year is something that he should be able to do through year 10. So the minimum premium might not make much difference at all there, but it is noticeable. It's almost twice as much. So let's look at the illustrations, because typically when you're funding less, this policy has a $65,000 MEC limit. Why is the minimum premium here, the base premium and term rider, is higher with this option, where I'm paying less in, than it is with this option? The reason why has to do with the specific company and product. So all companies have different rules. This is where everyone's situation is unique. So this is a Guardian L95 product. And here we go. This is the 100K lump sum option. What do we notice? Here's your base premium, $2,700 and change. RTR represents a term insurance rider. This target additional benefit is another term insurance rider. Specifically, this is a 1-year term insurance rider. There's the cost, about $450. So where we had that dollar amount of $3,400 or $3,500 for the minimum, that was this, plus this, plus this. 100 goes in. What he would be committed to are those 3 each year. But here he's funding 30K each year. How he's able to get 100K into the policy. You could not always do this with Guardian policies. They will allow, in the first policy year, whatever your base premium is, a PUA payment of 50 times that. And again, we can only illustrate that in the first policy year. So what we're able to do is design the policy for maximum cash value up front and then solve for the maximum annual amount. So really what we did here, this was a lot of fun, is solve for the 30K every year. So there's your base premium. Multiply this by 10. That's where we came up with this PUA. Add those 2 together. You get 30K. And then knowing that Guardian will accept more in the first year, there's the additional 70K PUA payment, which gives us the high upfront cash value and early break-even point. And then what we did was attach enough term insurance, which is a cost-effective way to raise the MEC limit. So now I'm staying within the boundaries of the field, right? When I'm playing the game to make sure I don't violate the insurance company's laws or PUA limits, anything like that. I just want to know the rules of the game and then maximize the policy based on those rules, which is exactly what we did here. So that's how we were able to get that base premium so low, because we're taking advantage of the lump sum up front only in the first year. Now, when we look at the second option, we can't even illustrate that 50x PUA or more than 10x in PUAs after the first year. So in order to get two consistent payments of $65,000, we've got to set that base premium here at $5,900. So the minimum's that, plus the cost of the term. Then we round it up a bit, which is why we saw that, what I have, 6,300 on the Excel sheet, something like that. We can commit to the minimum and add more discretion, is my point. But again, very comparable when we look at the two from a performance standpoint. And his age, frankly, plays a role too. If he was older, when I say older, 52 or 62, and working with the same numbers, what I would do differently is spread that lump sum out over 3 years perhaps. If he's in his 60s, especially his mid to late 60s, then what I might do is look to spread it out over 4 years. So as we grow older, it often makes sense to spread a lump sum out a little bit. And the reason why is it allows me to set the death benefit lower, have a lower MEC limit. I'm gonna use those lump sums to fund up to the MEC limit for 1, 2, 3, 4 years or something like that. So I hope you enjoyed this one. I had a ton of fun with it. I always have fun with lump sum scenarios or anything to do with cash value life insurance. But if you did enjoy it, please let us know. Hit the like button, subscribe for more. Let us know your thoughts below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.